Three quality stocks trading at fair value. This is a video that I do every month discussing three quality stocks. I give you my opinion on them, a very quick overview. I have a new stock I haven't talked about before. I'm gonna go over it. I know you're gonna enjoy it. And the other two are stocks I discussed before. They were overvalued and now they're trading close to fair value. Amazing companies. I'm gonna talk about them. And I really hope you enjoy it. Now, before I get started, I just have to be honest with you guys. The market's been pulling back. We're starting to see some opportunities, but there's nothing that's just making me like I'm dying to own that stock. There's some companies at fair value. There's a few opportunities. I'm gonna talk about them, but there's nothing that's just like an insane, amazing opportunity. Maybe there's AMD and there's a few other stocks, but there's nothing that's just amazing. So I'm still being disciplined with my cash position. I bought a few dips, but I'm still holding cash. I believe we're going lower. I think it's just getting started. It's not going to be a straight line down. And I do sometimes find stocks that I've just go heavy in. Like I told you guys about this stock that could double in 3 years was Cheniere Energy. It had amazing tailwinds and it's keeping me positive on New Year. It's up 14% year to date. And sometimes I do find those stocks, but I believe we're in a place where, there's some opportunities, but there's nothing that's just making me like dying to own that stock. There's nothing that's just too obvious where I just cannot ignore it. And there's a lot of opportunities that are starting to show up. One of them is FICO, for example. Now, if I could get that stock at fair value, that's an amazing opportunity. I would be dying to own FICO, and it's still a little bit expensive and they're pulling back. So I'm being patient, I'm being disciplined. And I just wanted to give you this update before I get into the video. And the first stock I'm going to talk about is CSX. I reviewed pretty much all the railroads. I did CP, I did CNI, and I'm trying to review all of them. I've been a big fan of the railroads as of recent. I think they're presenting an opportunity. And I believe CSX is mispriced in the market. It's an under the radar gem because people always talk about CNI. They talk about Canadian Pacific, Kansas City, and they talk about UNP, Union Pacific. But very few people are talking about CSX. And that's why I want to talk about it and get it a little bit more well known on YouTube. And CSX has a very interesting network in the United States and it's mainly focused inside the United States. So of course it's exposed to tariff risk, but it's not as exposed to tariffs as, for example, CNI going from Canada into the United States. And now we have a new president that's saying we don't need anything from Canada anymore, or things from Mexico with CP. It's not as exposed as other companies, and it's positioned in a key industrial area in the United States. There's a lot of growth happening in this area. There's a lot of data centers, a lot of chip manufacturing, a lot of jobs, a lot of companies, a lot of reshoring happening in this area. And I'm invested in construction companies in this area because I believe a lot of things are happening over there. And if you believe in a lot of industrial space coming back in the United States, things reshoring and, deglobalization, all that kind of stuff, all these things are extremely beneficial for CSX. And CSX would massively benefit from this trend. As I said, it's a very good company. In 2024, most of the railroad stocks saw decreases in volume or decline in volume. And this company saw a 3% increase in volume. So that was very interesting. Earnings per share was up 12% year on year. Very strong. In terms of net income margins, very high, around 24.7% net income margin. This is very high net income margin. Looking at return on capital, it's not the highest ever, but 13 to 14, 15% return on capital for a railroad is really not bad at all. It's really not bad at all, guys. And Charlie Munger said before that, normally the long-term return of the stock will likely be somewhere close to the return on capital. So if, for example, CSX returns 14, 15% on capital, you could expect 14 to 15% a year. It's not always the case, but most of the time, this is how it works. And in terms of shareholder return, they do a lot of dividends. For the last 20 years, they've been consistently raising the dividends. And they mostly do buybacks. They do a lot of buybacks at very good prices and 44% buyback ROI. And they've been doing well in terms of buybacks. Looking at the valuation on a forward PE basis, it's trading at 17 times earnings. 17 times earnings for a monopoly. You could say a monopoly, or you could say a wide moat company. No company is going to come in and build another railroad where CSX is operating in, especially in Florida. No one's just going to come in and replace them, take over them. We're always going to be using railroads 10, 20, 50, 100 years from now. It's always going to be the most efficient way to move stuff around. And this is just a beautiful business model, 24% net income margin, 14, 15% return on invested capital, and it's well positioned in a key area benefiting from longer term tailwinds in a lot of reshoring happening inside the United States. At 17 times earnings with 12 to 13% earnings per share growth, is really not expensive. It's not expensive at all, especially in the current overvalued market that we're in. That's how I think about it. And especially if you compare it to other railroad companies and we compare it to CP, CP is trading at 21 times earnings, UNP is trading at 19 times, CNI is trading at 18 times, and this one is trading around 16.4 times. So it's really not expensive at all in terms of compared to other railroad companies and against the market in general for the values that you're getting. And for their own guidance for the next 3 years, they're expecting earnings per share of high singles to low double digits. And this is what the analysts have. They have between 8% next year, and after that, they get back to 12 to 13%. And I believe the average will likely end up being around 12%. And you have like a 1.8% dividend. And I could see a potential multiple expansion if the company gets back to the 5-year mean multiple, which was around 18 times. And I believe it should be trading around 18, 19 times easily, especially if we do have the reshoring stuff that I'm talking about and all the data centers that are coming up in this area. There's a lot of growth happening over there. So I just see a lot of things happening. And I could easily see 12, 13, 14% annual return with a very safe company like CSX. And I think it's one of the best railroad stocks in the market that not a lot of people are talking about. And again, this is not a quality stock at an undervalued price. It's mostly a fairly valued price. And that's why I decided to talk about it in this video. The second one is NVO. This is a stock I talked about on YouTube, and I did an analysis on the stock, and I determined that NVO was overvalued at $87 per share. And I got a lot of support, but I also got a lot of hate that I'm trying to time the market. But I'm not trying to time the market. I'm just trying not to overpay, and I'm trying to pay a fair price for the company. And my fair value on NVO was $78 to $79 per share. And now it's sitting at $81 per share, down 48.5% over the last 6 months. And I think NVO over here is getting very interesting. In terms of GLP-1, they have a 65% market share. 65%, just massive. And they're also very big in diabetes and a few other things. It's a huge company. And I did do a deep dive. You could check out the video again. This is mainly an overview. And for NVO, their patents for Ozempic and other things, they don't expire between 2031 to 2032. So there's a lot of competition coming in for to challenge their dominance in the weight loss market. But from my research in terms of Pfizer and other companies that are creating those drugs, they're not going to come in before 2030, 2031. So there's still a few years left for you to make a decent amount of money with NVO stock. And as I said, NVO is a very good company. They have 35% net income margin. This is as high as Microsoft, very high net income margins, very profitable. Return on capital, huge, 65 to 72% return on capital, extremely high. Looking at the forward PE ratio, it was trading as high as around 41, 42 times forward earnings. It was very overvalued. The mean was 25 times earnings, and now it's trading around 23 times earnings, which in my opinion is much better, fairly valued for the company. And I believe is somewhat of an overreaction in the short term on NVO. It was just priced to perfection. A few things did not go too well in terms of trials versus Eli Lilly. And the market overreacted, and the stock is down 42% in 6 months. And it's starting to present a good opportunity. And that's why I'm talking about it here. Now, looking at earnings per share growth for the estimates, the analysts are expecting 22% next year again. And then it's going to drop to 13%, 12%, 12% again. And this is what I used for my valuation model on NVO. I used next year's number of $3.88. Then for the 4 years after 2025, I put 13% earnings per share growth. And I believe, honestly, it could end up being a little bit higher, because for the growth to drop from 22% to 13% with competition not coming in before 2029, I don't see how that's going to happen. But it's very possible. Although NVO also did a new acquisition, so the acquisition is also going to boost their growth, and they might do even more acquisitions. They're going to also buy back stock, do so many different things. So again, I don't see how that's going to happen, but I'm pricing it in. Okay, so that's going to be a little bit on the conservative side, and I put it in 13%. For the 4 years after 2025, I get $6.33 per share. And I did tell you guys that the mean PE ratio was around 25 times earnings. So I'm going to take the 633 and I'm timing it by the mean multiple, which is a little bit above the current one of 23.5. So I'm timing it by 25 times earnings, which I believe is fair. This is $158 per share. If we divide it by 2, I get my number of $79 per share to get it double over the next 5 years, or a 15% CAGR over the next 5 years. So if it's $79 per share for me, for my targeted return, which is minimum of 15%, doubles the average 8% for the S&P, is $79. Now it's trading at 81, and with the way NVO has been going down for the company, and using the gross numbers of 13%, dropping from 22% all of a sudden, it's looking very good, I have to say. So NVO for me, it's looking very interesting, especially if it gets to 79 or below. Could happen any day, could happen tomorrow or the day after, and I would definitely keep an eye on it. It's looking very good, and that's why I decided to talk about it. The last one, and a lot of you guys are gonna be shocked, you're gonna hate me for this one, and this is Adobe. And I did do a video on Adobe. I was extremely bearish on the company, and I was bearish on my video last year. I've always been bearish on Adobe. And a lot of you guys believe that I'm bearish because I hate the company. And I don't hate and I don't love any company. I just try to find out how can I make money in the market. That's my main goal. And I can get bullish on anything and I can get bearish on anything. Even Bitcoin. I can get bullish on Bitcoin if I can see I can make money in Bitcoin. Like, I don't care. My main goal in the market is to make money. That's how I look at it. And for Adobe, even though I'm not a big fan of, the company in general, but it's looking interesting. I see a good setup, and I could see a potential way to make money in Adobe. And that's why I decided to talk about it and switch my view from extremely bearish to, conservatively bullish, I would say. And Adobe has been a disaster, down 27% over the last 6 months. This is a quick overview again. I have a full video on it. It's now trading at 20 times forward earnings. This is non-GAAP. They have a lot of stock-based compensation, but 20 times forward earnings. This is exactly when it bottomed before, in October 20 of 2022. And back then, whenever it bottomed at this multiple, after it bottomed, the stock went up 125% a few months later. So on a historical basis, at 20 times earnings, as you can see on this line, it has been a good time to be buying Adobe. At this level, at this valuation, it has historically been a good time to be buying Adobe. But looking at Adobe with such high net income margins, over 93% recurring revenue, and around, 11, 10, 12% earnings per share growth for many years to come, and a very good balance sheet, and to be a potential multiple expansion from 20 times, the mean was 33. I'm not saying it's going to go back to 33, but I could easily see a multiple expansion from 20 times back to 23, 25 times with 12, 13 earnings per share growth. That's not bad at all. That's why I'm saying good setup. And yes, AI maybe is taking over, but people are still going to use Adobe. And even now, a lot of things could be used with AI, and people are still using Adobe. I mean, that's just the way it is. And I agree on the whole AI narrative, but you don't have to stay in Adobe for the next 10 years. You could stay for 2 or 3 years on this valuation, and you could potentially do something about it and make money in the stocks. You don't have to be here for 20 years. That's just the way I look at it. So for me, Adobe is looking a little bit better than when I talked about it in the video. It's trading at my fair value level. It was 385. Now it's at 412. It's very close. So I like it here. It's a good setup. And that's how I look at it. My favorite, honestly, was CSX. That's my style. NVO is the second best, especially below 79. Then Adobe is not my favorite, but I had to talk about it. And this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.